mutual funds can either be actively or passively managed. Active management means that the mutual fund is there's a portfolio manager in place who makes active decisions as to the investments that the mutual fund holds. So for example, if the benchmark was the S&P 500, the portfolio manager could decide to hold a certain stock in a larger percentage than it's contained in the S&P 500. He could overweight the stock if he likes it, or he or she likes it. He could underweight the stock if they don't like it. And this process is referred to as active management. In other words, taking active positions in securities to reflecting one's views vis-a-vis those securities in order to try and better the performance of the benchmark of that mutual fund. The other way of doing it is through passive management. The idea is basically to replicate the performance of the benchmark. And there would typically be a portfolio manager, but his role would be more to administer and to make sure that the performance was very much in line with the benchmark, and largely a lot of this would be done with computers and automated trading systems, and stocks or bonds or the securities of that mutual fund would ultimately be held in very as close as possible to how they're held in that particular index, for example the S&P 500. So we'd basically be replicating the index and try to get a performance that's as close as possible to the performance of the actual index. And the fact that this is done on a somewhat automated basis allows the costs of the mutual fund, the management fees, to be typically reduced, and it allows the performance obviously to be very close to the benchmark. So there's active management where we're basically taking a view that we're hopefully going to be better than the benchmark, and passive management where we basically said we're going to try to be in line with the benchmark. Now, what have researchers found, and what do many people say with respect to active and passive management? Well, in very mature markets like the US equity market, for example, many people argue that it's very difficult to do better than the benchmark. And why is that? Well, there are a number of reasons. First of all, there are so many people that are trying to do the same thing that if somebody finds an undervalued security, it's very unlikely that it's going to be the same investor that finds that undervalued security next time. Secondly, trading and management costs reduce the performance. As we said, in the case of active management, the management fees would typically be higher. In the case of passive management, there would be, in some cases, a very small fraction of the the annual percentage management costs of an actively managed fee. Secondly, because funds report their performance periodically, i.e. at the end of every month or at the end of every quarter, basically there's tremendous pressure to deliver performance in the short term. You know, we as investors and savers, in the case of saving for the long term and compounding our money, we care about performance over the long term. But because these funds are being evaluated, and even we as investors will look at their performance over the last quarter, last month, it's just human nature, the funds have to deliver performance also on a short-term basis. And that means that often they have to make decisions that allow them to generate short-term performance, which can come at times at the expense of long-term performance. And second, and lastly, it's very difficult to evaluate an actively managed fund, because in order to do that, you need a lot of data, and many years will have passed by to see whether that active management process is actually bettering the benchmark. And even if it does, it's no indication that this will happen into the future. And what it means effectively that it's very difficult in very mature markets to assess whether an actively managed product will better the benchmark, but we can be sure that the costs are higher. So many people argue that for a mature market, because of the difficulties of consistently finding undervalued stocks, because of the difficulties associated with having so many people looking at the same investment and the nature of the competition, it means that for very mature markets, passively managed funds where we can be sure that the costs are lower are a very attractive alternative.